So with that, I'm going to go ahead and call this meeting to order. And our first order of business is to have roll call called by our general counsel. So Will, would you call the roll, please?
Thank you, Madam Chair. We'll start with committee members who have registered. Assemblyman Ken Cooley.
Here.
Here. Senator Travis Holdman. Here. Representative Matt Lehman. Assemblywoman Pam Hunter. Senator Bob Hackett is here.
Here.
Representative Wendy Thomas.
Here.
Representative Carl Anderson. Representative Tom Oliverson. Representative Jim Dunnigan.
Here.
Senator Eric Nelson. I do see he is on. There he is. Okay. And Delegate Steve Westfall.
Here.
And moving to non-committee members who have registered, Representative Derek Lewis. Representative Brenda Carter.
Here.
Senator Vicky Sawyer. Assemblywoman Michelle Gorlow. Senator Amanda Capoletti. Vice Chair Senator Walter Michel. Here. And we have Chair Carlton. And if there is, it looks like there's an 816 number with an area code that is generating some noise. If you could please mute. And are there any other legislators on that I did not call? Okay, Madam Chair, we'll just need a motion to waive the quorum requirement.
Thank you very much, Will. So if I could have a motion to waive the quorum requirements, please.
So move.
So moved. I have a motion by Mr. Cooley, second.
Second. Delegate Westfall.
Thank you for identifying yourself. Any questions or comments on the motion? Hearing none, all in favor, say aye and signal by raising your hand if you're on Zoom so we can make sure that it's recorded.
Aye.
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 Okay, thank you all very much with that being taken care of. So thank you everyone for taking time on a Friday morning or almost Friday afternoon for some of you to join us today. We know everyone is very, very busy, so we appreciate your participation and we will try to make this meeting as expeditious as possible. The purpose for today's meeting for this committee is to conduct some business in advance of our July meeting in New Jersey so that the committee is able to handle all of the issues that'll come before us in New Jersey and take care of the agenda in a timely manner. We'll get started today with a continued discussion on the enhanced cash surrender value endorsements on life insurance policies and their interaction with the standard non-forfeiture law. This issue has been discussed at a very high level during the NCOIL NAIC dialogue, the past two NCOIL national meetings, and now is an opportunity to get more into the weeds on this issue by discussing it in this committee, which has subject matter jurisdiction over the issue. We'll then have an update and discussion on the S&P Global Rating proposal to revise its methodology for assessing insurers' financial strength, ensure risk-based capital adequacy, methodology, and assumptions. And there has been a lot of activity on this issue since it was first brought to our attention earlier this year. So this will be a productive overview and discussion on what the status is and what the next steps are. So just to kind of give you a lay of the land, that's where we're headed this morning. So let's go ahead and get started. The first issue we're going to bring up today is the discussion on enhanced cash value surrender. So with us today to present on this issue are Nate Chapo, partner at Tatum Muncham Rosenbaum LLP, and former director of the Illinois Department of Insurance. We also have Karen Melchant, Regional VP, State Relations, American Council of Life. But before we hear from them, I'd like to turn things over to Indiana Senator Travis Holdman, former NCOIL president, for some comments. So Senator Holdman, how are you? You have the floor.
Well, I'm doing well, Maggie. Thank you. Thank you. I should say, Madam Chair, excuse me for being too informal, but this issue came to my attention here in Indiana with what was going on, which appears to be a violation of the standard non-forfeiture law in Indiana. And just to bring folks up to speed, the enhanced cash surrender value endorsements are limited time offers made to life insurance policyholder to surrender their contracts for amounts well over the cash surrender value for the purpose of terminating the policy and allowing the carrier to convert reserves to profit. At the same time, there are viatical settlements, which are heavily regulated. There are sales of a policy owner's existing life insurance policy to a third party for more than its cash surrender value, but less than its death benefit. Upon hearing about this issue coming to Indiana, I sent a letter to our new commissioner in Indiana, Amy Beard, and we followed that up with dialogue and executive meetings with the NAIC folks at our meeting. And I can't remember where that was, Tom. Where was that meeting that we talked about that? Was that in Phoenix?
Scottsdale.
In Scottsdale,
I
yes.
think, yes. It was in Phoenix. And I think the thing that disturbs me most is just the violation of what appears to me to be the rule of law. There's a course for an insurance company to take if they wish to do enhanced cash surrender value endorsements, and that's to become a viatical settlement company and to be regulated as one instead of doing this as a life insurance company apart from viatical settlement legislation in all our states. And so with that, that's really all I have to say, Madam Chair. And I know there are other folks who wish to speak on the topic, and just think we need to pursue this. We have had somewhat of a positive response from Commissioner Beard here in Indiana to basically send a letter to put an end to this practice by life carriers. And so hopefully that will come about. But I'll be quiet and let others speak on the issue, but appreciate your time today, Madam Chair. Thank you.
Thank you very much, Senator. And after we get everybody done, I'll be sure and give you an opportunity for any closing comments if you'd like to.
Thank you.
So with that, I think we'll go to Director Chapo first. He is first on the agenda, and also committee members and those participating. There are some slides available on the website, so don't worry about trying to keep up with everything. He will be presenting slides, and those are being made available to you. So with that, Director Chapo, please proceed.
Thank you, Madam Chair. Appreciate it. And thanks, Senator Holdman as well. I'll try to do a screen share, put the slides up. Will doubtless be unsuccessful. Where are they? Jeez. Yeah, not working. Give me, with your indulgence, Madam Chair, if I could take a shot at this. Is that up?
We still see you.
Oh, I'm sorry, Madam Chair.
No, that's okay.
I practiced this before and
I
it worked.
always have to have staff in the room when I have to do this. So believe me, I got you.
Yeah, I got to get, that's it. I got to get staff. I haven't had staff for the last 20 years. That's the
It
problem.
helps to have somebody under 35.
Yeah.
Mine is 27, so there you go.
Oh, geez. Just one more minute, Madam Chair. I'm sorry.
That's okay. We're good. Best to have everybody on the same page.
Come on, bro.
I know. I am truly sorry. I don't understand what the problem is. Boy, oh boy. Let me try something else. There we go. How about that?
Success. We congratulate you. Happy Friday. Let's hear.
That is rare technological success for me. Okay, apologies again. So my client is the Life Insurance Settlement Association, Lisa, the trade association for secondary market participants. Some feedback, I'm not sure.
Somebody at line, area code 973 is on a call, it sounded like. They're not muted.
All right, let me try again. So Lisa is my client. They're you're mainly licensed life settlement brokers and providers in thoroughly regulated secondary market, as Senator Holman mentioned before. The concern that they've raised, and we're grateful to have an opportunity to talk about, is carriers making spiked limited time cash offers to induce surrender of the benefits of the policy and enhance cash surrender value. It's only being done in a small corner of the market now, and what we're hoping that will not spread and will be prevented from continuing. There's some examples here of these big spikes. Cash surrender value under the issued policy of $4,700 being spiked to $14,000 for 4 months for this limited time offer. Another one we've seen in the market was $19,000 to $360,000, and another one we saw was $0 to over $500,000. These are the increases in cash surrender value for limited times. That the graph is basically what it looks like. You've got the steady progression of a normal cash surrender value, and then you've got the big jump. It stays even there during the offer period, and then the offer period ends and it goes back to the issued policy's cash surrender value. The issue that Senator Holman flagged is the standard non-forfeiture law smoothness requirement. Standard non-forfeiture law, of course, a pillar of the insurance code. Down at that third dot point, the thing that standard non-forfeiture law is mainly known for is establishing minimum values for cash surrender for products that have an investment component. The smoothness requirement is not as well known, but it was added after extensive debate in 1980, and it was meant to apply in addition to. So there's two requirements. You have to meet minimums, and then the progressions that can have to be consistent, as you can tell from the second dot point, the title of the new section added to the standard non-forfeiture law. This is all from 40 years ago. Did some digging, found very clear legislative history on this and a very clear understanding of what the smoothness requirement meant. The report that preceded the adoption, the drafting and adoption of the smoothness requirement, said that the policy concern was equity among policyholders in different policy durations, and noted that the law at the time didn't place any constraints upon the progression of cash values. The goal was for the cash values to follow an equitable pattern as they progressed. That led to the adoption of the smoothness requirement in 1980. It's drafted of this NEIC model, where the actuaries, the life actuaries from the departments, they said that the changes were extensive and dramatic. Very clear that the underlying purpose is to require a reasonably orderly sequence of increases, and that the purpose was to cure the defect that the standard non-forfeiture law previously allowed sharp increases in cash value. The Society of Actuaries proceedings following the adoption of the smoothness requirement explained very clearly what the rule was. You can't have erratic cash values, you can't have sharp jumps, you can't have spikes in the non-forfeiture structure, and you can't have a policy design that provides benefits discontinuous in nature and available only during certain windows of time. Back to the graph I showed before, if you line that up, was what's happening in the market with the rules I just quoted. you know, hoping these would be rhetorical questions of whether that progression of cash values you see there in the graph, does it follow a reasonably orderly sequence of increases? No. Are they erratic? Yes. Is there a spike, a sharp increase, a sharp jump during that middle portion there, that during the offer period? Yeah, that's a spike, that's a sharp increase, that's a sharp jump. And are the offers made in the middle of the graph benefits discontinuous in nature, available only during certain windows of time? These are all the standards that were understood by the authorities at the time the smoothness requirement was added. You know, again, hopefully rhetorical. Does this comply with the standard non-forfeiture? No. And I don't think I'm being facetious in saying it would be hard to intentionally design a product less compliant or with a less smooth progression in cash surrender values. The discussion should really begin and end with what the law says and what it requires, but it's certainly worth looking at the rationale behind the law, which is consumer protection. And it was explained at the time what the consumer protection issues were. The report that preceded the adoption of the development and adoption of the smoothness requirements said that it described a typical case, a troubling case to the committee, where actual values are 0 for 9 years, arbitrarily set equal to a desired value for year 10, well in excess. So they're saying this is what we're trying to stop. This is an example they've seen in the market where you had 0 cash value and then a big jump in year 10, and the consumer protection.
We lost you for a moment, Nat.
I believe our presenter has frozen.
Pat, can you hear us? We're texting you to advise you that you're frozen.
Excellent plan. We'll just stand at ease for just a moment. Technology is wonderful when it works.
Am I back? Am I back?
Yes, you are. Welcome back.
All right. Okay. Do I need to, the slides gone again? Do I need to pull those up again?
I'm afraid
Yes.
so.
Oh, boy. Everybody's concerned about that, I am sure. There they go. They up?
Yeah.
Got them, Madam Chair? Okay,
And you are
great.
on slide, currently on slide 12 is what I see noted.
Thank you. Thank you again for the chair's indulgence. So it is a practical matter. You know, let's say that you've got a policy, you're trying to decide what to do with it. The cash value is going down. You ask for an illustration from the carrier. They say, you know, let's that example I used before. It was about 18 or 19,000. That's the cash surrender value, and then they project the cash surrender value continuing to go down in your policy because you're not funding it more, or they project it if you're going to continue funding it, they project it going up to say 20. You say, well, I'd rather use my resources somewhere else. I think I'll surrender, not knowing that an enhanced cash surrender value offer is coming in the mail. You know, you had an illustration from the carrier that didn't tell you that was coming. You surrender, and then say the next day or the next week or the next month, these offer letters go out that you would have gotten paid 1,800% higher, you know, that 360,000 from the previous slide. So a person who is, if you got another person who is an identical risk to you, they had the identical policy, they pay the identical premiums for the same period of time, and they didn't surrender, and then they got that offer letter in the mail, what has ended up happening is they received 18 times the benefit for the same price as you. The inequitable concerns of the drafters is obvious there. So that's the basic law. As a policy matter, I mean, again, that's, our position is the standard non-forfeiture law argument. It should be the beginning and end of it. Senator Holman referred to the rule of law. But as a policy concern, it is important to us that that these offers mimic like settlements, and they don't follow the Life Settlement Act consumer protections. I've got three. I'm not going to read every word of these. I did find three comparisons where the life insurer enhanced cash surrender value offer materials used almost the same language to promote the product as life settlements providers used to promote their product. They're close to life settlements. Both enhanced cash surrender value offers and life settlements are limited time big cash offers in exchange for forfeiting the policy and the death benefit. That's a risky proposition, and the Life Settlement Act protections are tailored to those risks, and they're observed by life settlement licensees, but not observed in enhanced cash surrender value offers. Some of those key rights include rescission rights. So the life settlement statutes require by law that a life settlement offer rescission rights of 15 to 60 days, depending on the jurisdiction. That's important. You could have seller's remorse. Somebody got offered a big pile of cash. They didn't really think it through. They shouldn't have given up their death benefit. Maybe they talked to their beneficiaries. Dad, what are you doing? So you can rescind the life settlement by a statutory right. And if the insured dies during the rescission period, and this happens frequently and it involves millions of dollars, rescission is automatic. You don't have those protections and enhanced cash surrender value. Once you sign, you're done. Policy's gone. There's a fiduciary duty for brokers in the settlement market, not on the enhanced cash surrender values. There's statutory requirement of a certification of consumer competence, which is important with these elderly consumers. And you have to disclose competing options in a life settlement. That's not being done in these enhanced cash surrender value offers.
I'm sorry, hold on for a second. Folks, we can't, please, if you're not speaking, please mute your line. It's just flat out rude. Sorry, Matt, go ahead.
Oh, sure thing. Appreciate it. Did some more digging, found the ACLI's testimony when they're drafting the NEIC viatical settlements model, and there was a back and forth where the idea of carriers competing with life settlements is brought up, and the ACLI said, no, you shouldn't do that. You got your, there's accelerated death benefits. Those are authorized life insurer benefits. They're regulated, they're protected by the department. If you're doing viatical settlements, you need to be a viatical settlement company. And again, these offers closely mimic life settlements. So the bottom line is that the enhanced cash surrender value offers violate standard non-forfeiture law and avoid the protections of life settlements, which are similar limited time cash offers. An issue has been raised whether the smoothness requirement applies to universal life. It plainly does. Plain language of the standard non-forfeiture law smoothness requirement, Section 8 says it shall apply to all policies. Standard non-forfeiture law does have an exemptions section, Section 9. It enumerates, I think, 8 products which are exempt, and universal life is not one of the exempt products. So it's a basic plain language reading. Standard non-forfeiture law does authorize rulemaking for universal life, but it's only for the minimums. As we discussed before, there's 2 requirements in standard non-forfeiture law. You have to meet minimums, and you have to have the smooth progression of cash values. The rulemaking in the universal life model only applies to minimums. It's silent on smoothness. Everybody knows if you got a statute and a regulation, and the statute says one thing and the regulation's silent on it, then the statutory language would control. And again, that's a smoothness requirement. The model reg I think it's important to note that its purpose said it doesn't supersede existing requirements, so that it would not supersede the standard non-forfeiture law. And again, the universal life model non-forfeiture provisions apply only to minimums, not to smoothness. This was well recognized at the time. The American Academy of Actuaries had a task force that NAIC asked to consult with it during the drafting of the Universal Life Model Regulation. Quite a categorical statement by the task force. Universal life policy should comply with Section 8 standard non-forfeiture law. That's the smooth cash value test. The American Academy of Actuaries then a few months later made a statement on universal life rulemaking. Said in our report, we stated what we believe to be obvious. Universal life should comply with Section 8 of the standard non-forfeiture law regarding smooth cash values. It should not be necessary to add this requirement to the model regulation. The requirement already exists. Again, basic statutory interpretation. If you've got a requirement in a statute and the regulation is silent on it, then the requirement stands. Society of Actuaries, in a later discussion, it said the same thing. Universal life model, when it was created, had its apparent main purpose the creation of a commissioner's reserve valuation method standard, which affected reserves and taxation. The universal life model, the Society of Actuaries explained, because of this, the universal life model only addressed a small part of non-forfeiture controlled front-end loans and surrender charges. It doesn't mention smoothness. So smoothness, by the plain language of the standard non-forfeiture law and by well understood interpretations, smoothness does apply to universal life products. That's all I got. I should probably declare victory and move on, since I haven't been cut off again and I lost my slides. But Madam Chair, we really appreciate your consideration. We appreciate Senator Holman's interest and the committee's indulgence, and happy to answer any questions.
Let me unmute myself. There we go. So thank you very much. We'll go ahead and go to our next speaker, and then we'll open it up for questions. So with that, I believe we have Ms. Melchert from ACLI.
Good morning, Madam Chairwoman. Yes, my name is Karen Melchert. I'm with the American Council of Life Insurers, and thank you for the opportunity to provide a brief statement in response to issues raised before this committee regarding enhanced cash surrender value endorsements. First, let me address the issue of whether or not these riders violate the standard non-forfeiture laws and the accompanying smoothness test. While we do not believe that the use of enhanced cash surrender value endorsements violate the smoothness requirement under the standard non-forfeiture law, it is our understanding that at the March 2022 meeting in Las Vegas during the NAIC NCOIL dialogue, Commissioner Glenn Mulready from Oklahoma indicated that he had reached out to Director Judy French from Ohio, who currently chairs the A Committee, which is the jurisdiction over life insurance issues, and has requested that Director French bring this issue to the Life Actuarial Task Force, otherwise known as LATIF. And we believe that that is the appropriate place to begin this evaluation of whether or not there is a violation of the smoothness test. As I said earlier, we do not believe that is the case, but we do think that LATIF should take a look at it to settle the matter once and for all, and to perhaps put additional guidelines around that. And if that is the case and it would require further statutory changes, then I think that would be an appropriate discussion for NCOIL to take up. But it is an actuarial evaluation, and we think to start with the Life Insurance Actuarial Task Force would be an appropriate place. Furthermore, I don't have a definitive statement. We have not had the chance to develop a policy statement that I can share with you today, other than it is widely believed by our members with whom we've talked about this, that this does not violate the smoothness requirement for various reasons. So unfortunately, that's about all I can say on that issue, but we do think that an examination by LATIF is appropriate, and we look forward to participating in that process, and then coming back to discuss whatever necessary changes might be with NCOIL at that time. With respect to other issues that have been raised on the use of enhanced cash surrender value endorsements, they are not a life settlement transaction. They are endorsements, most of the time added at the time of issuance. And they are offered across the block. They cannot be offered individually. It has to be across the same block of business for everyone, whereas a life insurance settlement offer is solely discriminatory in that they offer those to individuals after extensive underwriting, after extensive review of the health of the policyholder. There are no such underwriting provisions for the exercise of enhanced cash surrender endorsement. It is something that is can be and should be elected by the policyholder. It is not unilaterally offered or enacted by the insurance company. They can't activate it. It is at the sole discretion of the insurance policyholder. If they want to surrender their policy, it's an option versus a life settlement. That's certainly another option too. But these enhanced cash surrender values are offered undiscriminatorily across the book of business and cannot be addressed at an individual policyholder level. Pardon me. In addition to that, sorry, insurance companies are highly regulated entities and they are subject to the Unfair Trade Practices Act. And these riders, these endorsements must be filed and approved by the insurance department before they can be used. And the Unfair Trade Practices Act, among many things, prohibits discrimination. And those laws would also apply to these riders as well. In contrast to a life settlement, where a policy holder is selling their policy to a acquiring company, an enhanced cash surrender value is just that. It is a surrendering of the policy. So when you surrender your policy, the policy ceases to exist. When you sell it to a life settlement company, they continue to pay the premiums to keep that policy in force. So there's a difference with continuing a policy in force than obviously surrendering a policy. When you surrender a policy, and you can do that for any variety of reasons, to an insurance company, that policy ceases to exist. In order to reinstate it, the policyholder would have to go through underwriting again and would have to either pay the missing premium that had not been paid during the period of time when they had surrendered their policy in order to reinstate that policy. That's standard across life insurance policies. When you surrender it, you are surrendering it. It's very clear. You have to sign that over and you have to make sure that that's something that's been made clear to you. So they're obviously very different than what a life insurance settlement company is. They are enhanced value benefits that are added to the policy most of the time at the beginning of the policy or elsewhere in accordance with the insurance company's operations. But again, has to be across the entire block of business. It can't be cherry picked for the ones that they think are appropriate. And I think most importantly, these enhanced cash surrender values are a benefit to the consumer. They do not harm the consumer in any way. The policy holder is under no obligation to surrender the policy at any point in time. They are the ones who decide if they want to exercise the benefit. It provides sorry, I just saw the chat. It provides a consumer,
I apologize.
No, you're fine. It provides the consumer with another option when he or she might be considering selling or surrendering their policy for the cash value that is accumulated. And unlike life settlement offers whose value is based on an individual assessment of the health of the policyholder, enhanced cash surrender values are calculated uniformly across the block of business based on a formula included in the benefit. Now, I can't speak to the examples that Mr. Chapo provided to you where these spikes in offers in limited time to exercise those options, because from the discussions I've had, I'm not aware of that practice. So I'm not prepared to respond to that because I don't have knowledge of that. But I'd certainly like to see the examples that Mr. Chapo has noted and to see whether or not there is an issue there. But these are very widely used, but maybe not in the circumstances I think that Mr. Chapo has pointed out. They are endorsements that are added, and they come in a variety of forms, and most of them don't have limited time options. And again, as I said, they are all filed and approved for use by the Department of Insurance. They are subject to all of the regulations that life insurance companies are required to follow. In contrast, life settlement companies, up until the laws were enacted by following the NEAC Life Settlements Model Act and the NCOIL Life Settlements Model Act and the NEAC Viatical Settlement Model, there were no regulations around life settlement companies, and that is precisely why those laws were put into place. We don't think that these are in violation of any laws. We think they are perhaps an alternative to a life settlement option that a policyholder may select to choose. It's not something that we think should be prohibited or turned into a life settlement company. In order to do them, they are enhanced value endorsements, which are added to universal life policies primarily. So I thank you for your time, and I'm happy to answer questions to the extent that I am able to, understanding that I am limited in my knowledge, and I'm happy to respond in writing to further questions if I can't answer them today.
Okay, well, there we go. Thank you very much. I'm going to go ahead and open it up to other committee members right now to ask questions. It does sound like there does need to be a lot more discussion. I don't think we'd be having this conversation if there wasn't an issue somewhere and someone had found a way to weasel something through there if there's an issue. So I think there's going to be a lot more discussion about this to get the actual impact of that. So with that, I'd like to go ahead and if you'd like to request, you can either raise your hand, speak up, or put your name into the chat, and then be happy to recognize you for any questions. I don't have the full view, so.
Madam Chair, it looks like just Director Chapo has his hand raised.
Okay, so Director Chapo, if you'd like to go ahead then.
Thanks, Madam Chair. I mean, I got a bunch of notes here, and I don't want to point by point rebuttal. I just got a big picture point, which is that Karen brought up, Karen was describing her understanding of the enhanced cash surrender values as something that's done at policy issuance, that it's widely done throughout the industry on a variety of forms, and that they're not limited time options. We're maybe talking across each other a little. There are certainly products, endorsements, riders that have been used for years that are called enhanced cash surrender value offerings, and we don't have a beef with those. I want to make clear that the way I heard Karen describe it, those are not the ones we're talking about. There's a very small strata that's just come up in the last few years, unlike, at least the way I understood she was explaining it, these well-established enhanced cash surrender products. And the product we're talking about is very new. It's only been seen by 2.5 companies, depending on how you want to describe it, and they're limited. That they're exactly what I described before. I mean, that's a small portion of tiny portion of the market. They are indisputably just those, that small slice, indisputably making these kind of spiked limited time offers. And they're using the same nomenclature. They're calling them enhanced cash surrender value products. We're not raising a concern about the ones, at least the way I heard Karen describe. We're not raising concern about products she was describing. Widely used, available at the issuance of the policy, and not spiked offers that come out of the blue, 10 years into a product. What I described earlier is what we're talking about, which is what I was describing. What I thought I heard Karen describing these widely used at issuance, non-spiked offers where we are not objecting to those. The same label has been used for all of the above. We're only objecting to that recent small slice of the market. So I want to make clear that with respect to the way I heard Karen describe it, we do not object to those.
Thank you, Mr. Chapo. So with that, I believe there's a lot more conversation needs to happen to make sure that everyone's talking about the exact problem that's occurring. So a lot more information needs to come up, and I do think NCOIL is the proper venue to have this conversation, because ultimately it's those of us.
Madam Chair,
that,
we have Senator
are-
Cooley eagerly waiting to ask a question.
Okay, so with that, I think this is a good spot for us to have this conversation, because ultimately we're all responsible to our constituents that are approached with these issues. So with that, my friend from California, Mr. Cooley.
Yeah, thank you, Maggie. I think your comments there is an important topic to have the conversation, so I sort of amen to that. And I want to acknowledge Karen makes a good point, noting that you have unfair practices laws, other similar laws of broad application. The approval process is itself making sure that the right things happen in the marketplace. I think the issue becomes those laws of broad application are important. They do sort of scrub the business, make sure it stays within the lines. But something like this, where it's offered for a short term to a limited audience, there's a reason we have a more specific statute. So always, if a law of general applications applies, that's always relevant. But where there are more specific statutes, that becomes important. And I think the fact pattern of what is going on, and is a limited universe of recipients across a book of business, and also for a limited time, it makes it a little harder to understand how the fairness issues work. So I certainly do agree that the broad statutes of application, which sort of lay down the boundaries of the business, are directly on point. But that, while true, we still have the more what specific statutes that are on the books that address this practice become relevant. So it is a good topic for discussion.
Always have to remember to unmute myself. I need to cross stitch that into a sampler. So any other questions from any other committee members or other interested parties at this time? Not seeing anyone in chat or any hands raised. So with that, Senator Holdman, if you'd like to be the cleanup hitter on this one, you're welcome to
Well,
it.
thank you. Thank you, Madam Chair. Appreciate your time today. And I think Assemblyman Cooley said it best. In addition to that, we have the smoothest requirement, which I think this practice violates. I think just the practical fairness question comes into play, and a right of rescission for those folks, I think gets ignored. And I would take issue with a number of things that ACLI said, or the representative made statement to. And I think it's a great topic to continue discussion around. And it has gotten the attention of the Indiana commissioner, and with a move, I think with an intention to foreclose companies from doing this any longer. So I think it is an issue that we need to have further discussion. Appreciate your time today, and I need to drop off the call. I've got another appointment, but thank you all for your time today. I really appreciate it.
Well, Senator, I believe Representative Dunnigan had his hand raised, but then it went down.
Okay.
Representative Dunnigan, did you still have a question, or did you want to take it offline?
Yeah, thank you. I'd like to just make a comment. So it seems to me we've got to get more specificity on the issue. What Karen talked about is a broader practice that's gone on for many years. Then it's been raised in Indiana that maybe there is a problem. It'd be really nice to get some specificity, what carriers are doing it, where it's being offered. I think we're talking about two different issues here, and I think we need to narrow it down.
Thank you, Representative. I appreciate that, and I apologize for not recognizing you earlier. So thank you very much. So with that, Senator, thank you very much again for bringing this issue to us, and we'll keep working on it. And I'm sure it'll be a topic of discussion in New Jersey very soon. So thank you very much.
Thank you. Appreciate your leadership. Thank you.
Thank you. So with that, we did have a couple more legislators join us. So we have North Carolina Senator Vicky Sawyer, South Carolina Representative Carl Anderson, and Kentucky Representative Joe Fisher, just for the record to make sure that they are recognized, that they are present in the meeting. So with that, I believe our next item for discussion is the topic of S&P proposed changes to its insurer rating methodology. As you can see on the website for NCOIL on the page with the materials for this meeting, NCOIL submitted a comment letter to S&P focusing on the notching aspect of S&P's proposal, which states that when examining the bonds held by insurance companies, S&P will lower or notch the rating of that insurer if the bonds were rated by anyone other than S&P. NCOIL has raised a number of concerns with the aspect of this proposal, including that it came across anti-competitive, contrary to the spirit and intent of the NCOIL Model Act to support state regulation of insurance by requiring competition among rating agencies. And if it's implemented, would create a caste system among rating agencies, particularly given S&P's market share. There's been a lot of attention on this issue at both the state and federal level, including a hearing being held in the U.S. House Financial Services Committee and the Antitrust Division of the U.S. Department of Justice sending a letter to S&P stating that S&P's actions would raise significant concerns that federal antitrust laws have been or could possibly be violated and warrant additional scrutiny. A copy of the DOJ's letter also appeals on is also on our NCOIL website. So as some of us may know, there is good news that the S&P did announce the withdrawal of the notching aspect of this proposal. While this is a positive development, it's important to note that it's concerning that S&P has not posted publicly on its website the comments that were submitted regarding its proposal. NCOIL will be reaching out to S&P to express our concerns regarding the lack of transparency surrounding this process. Additionally, S&P indicated that it plans to repropose something in this area, which is why I believe it's important that NCOIL stay vigilant and participate on this issue. It's also very important that we note that S&P has been invited to participate in this discussion today, and actually several times has been invited, but we have not received a response. So with that being said, I'd like to open this up for discussion from interested parties. Again, the notching aspect has been withdrawn, so I don't believe we need to go over that again. But it's important that we monitor the issue moving forward. So with that, I understand that Mr. Raucher from Deutsche Bank is here today and would like to make some comments. So with that, I'll go ahead and open it up to him. Then we'll have Jennifer Schulp from the Cato Institute. And then after that, I do have an additional person, Caitlin Colvin from Kroll Bond Rating. So we'll go ahead and have our presenter speak, and then we'll open it up for any questions. So with that, Mr. Raucher.
Thank you, Madam Chairwoman, and it's good to meet everyone on the line here. As mentioned, I'm a managing director at Deutsche Bank. Among other things, I help cover the insurance sector as it relates to advice on capital and capital structure. The S&P proposal is therefore very important to pretty much all of our clients. And I think what I'd like to do is just share a little bit of background and then a little bit regarding what the next steps appear to be in the process. First, let me just say that the opinions that I'm about to express are my own. They don't necessarily represent the views of Deutsche Bank. And, I know that any remarks that I make during this event are subject to public disclosure without review, notification, or context. So with that, maybe just to give very briefly background on the situation. So as many or most of you know, in December of 2021, S&P released a proposal regarding its capital methodology. That means that S&P has its own internal proprietary capital model that it uses to evaluate the capitalization of insurance companies that it rates. That capital model is not public, so the full level of outputs from the model are not observable to the public. And it is important, in my estimation, to how many insurance companies manage their capitalization, in some cases above and beyond state regulatory requirements. As mentioned, in December of 2021, S&P released a proposal to amend its existing capital methodology. That methodology has been in place since 2010, and there were a number of aspects of the proposal that drew the attention of the industry. From a sort of high-level perspective, S&P did indicate that the expected impact of the proposal was that it would only result in approximately 10% of its rated insurance company audience seeing adjustments to ratings. However, as it relates to its view of capitalization, it did announce that it expected there to be impacts to about 35% of insurers, so more material impact. On the one hand, they indicated that there would be benefits in the updated model from diversification. However, there were a number of aspects of the proposal that would negatively impact capital structures for insurance companies. And in addition, and importantly, there would be an incremental notching in the capital model for investments that were not rated by S&P. So the consequence being that non-S&P rated bonds, for example, would suddenly attract incremental capital. In addition to that, however, the proposal would impose several limitations on the use of debt and hybrid capital to help capitalize insurance operating company entities. And that would result in a fair amount of restructuring for insurance companies in the United States in order to properly capitalize the businesses. The original proposal had a comment date deadline of February 18th. In light of comments, which is noted have not yet been made public, S&P extended its deadline from February to March, further extended it until the end of April, and then most recently on May 9, indicated it is withdrawing the notching aspect of its proposal for non-S&P rated bonds. However, it also indicated that it is considering alternatives for the withdrawn elements of the proposed criteria. And so importantly, S&P has not indicated that this topic has simply gone away, but rather that it is considering alternatives. As far as next steps are concerned, S&P also indicated that it intends to issue a new request for comments that will incorporate any proposed alternative for the withdrawn elements, along with any other changes that it might consider to its original proposal. At this point, we don't have a view on what that updated request for comment will include. From a timing perspective, in light of the fact that it will need to release a new request for comment, S&P has indicated that it will not finalize its criteria until at least the fourth quarter of 2022, and there's risk that this will extend into 2023, which will, of course, result in some uncertainty for insurers that need to raise capital or otherwise engage in capital markets transactions without certainty regarding how those transactions will be treated. S&P further indicated that it will update market participants on the expectations of what will change, but at this point, we have no further information on exactly what that will entail. maybe I'll just pause there, and I know we have some other speakers on this topic as well.
Thank you very much. So with that, we'll go ahead and go to the other speakers, as I said, and then we'll open questions. So I believe next we have Ms. Schulp from the Cato Institute.
Thank you, Madam Chair, and thank you for inviting me to be here today to speak. I was one of the folks that testified in front of the House Financial Services Committee with respect to this S&P notching issue. Say 2 seconds of background on me. I am Jennifer Schulp. I'm the Director of Financial Regulation Studies at the Cato Institute, which is a think tank in Washington, D.C. My focus is on securities and capital markets issues, which also include the credit rating agencies at issue here. I want to thank Adam for giving that great overview of the situation and where everything stands at this moment. S&P has withdrawn the proposal. We do expect to see a new proposal. And so from my perspective and the sum of my testimony to the committee is that while this is certainly something that can raise anti-competitive concerns and is something that deserves continued attention, it is not something that is primed for legislative action at this point in time. And is rather something that, say, should remain in focus, but there should not be a rush to judgment in a legislative standpoint. My focus here is primarily on the federal law and legislation. First, because the proposal has been withdrawn, any new proposal that's put forward may ameliorate potential anti-competitive concerns or raise different ones. And it would be prudent to delay any sort of legislative action until the issue itself becomes more clear. I think what's also important to note, and particularly in the context of the federal hearings on this concept, is that there are other laws that already apply to prohibit anti-competitive behavior. As the chair noted, the Department of Justice had sent in a letter in response to the S&P proposal, noting the potential applicability of federal antitrust laws. But there are also specific rules with respect to regulation of the NRSROs that prohibit unfair, coercive, or abusive NRSRO behavior. It's possible that the type of proposal that S&P has now withdrawn would have run afoul of existing law. And finally, say in addition to just adding to the concept of things to think about here, is any sort of legislative or other action here should be narrowly drawn, because the proposed notching and the proposed methodology changes themselves go to the question of the NRSRO's ability to rate the creditworthiness of instruments and their own methodologies. Any legislative actions should be very careful to avoid taking steps that substantively regulate credit ratings and the credit rating methodologies. Really, the bottom line, as I see it, is this is something to continue to keep an eye on and to continue to be concerned about potential anti-competitive effects here. But with the withdrawn proposal, the appropriate thing to do now is to think and wait for a new proposal to see what sort of commentary that proposal itself requires.
Thank you very much, Ms. Schulp. Appreciate that. So with that, we'll go to our next speaker, which will be Ms. Colvin of the Kroll Bond Rating Agency. I have that correct?
Correct. Thank you, Madam Chair. KBRA very much appreciates the opportunity to speak on this very important topic. And thank you to Adam and Jennifer for giving such a great overview, and Madam Chair, of the issue at hand. Just a brief note on myself. I'm Caitlin Colvin. I run investor relations for KBRA. KBRA did participate in the House Financial Services Committee hearing on this issue. It was Angela Liang, our general counsel, that testified alongside Ms. Schulp, which we very much appreciated that opportunity. Brief statement on KBRA. We were founded in 2010. For those that aren't familiar with us, we are a global full service rating agency with 450 plus employees. Our mission is to provide transparent ratings and valuable information and thorough research to investors, particularly with respect to insurance companies, given their presence in the fixed income markets. We've rated over 4,000 entities, representing more than $3 trillion in debt. We're widely accepted by the investment community, including insurance companies. There are almost 1,000 KBRA only rated bonds in the market, and 1,250 plus KBRA plus another rating agency, which could be S&P, Fitch, Moody's, or DBRS, 1,250 of those transactions in the market. And without belaboring the point on what S&P's RFC did, I think that's been covered adequately for the group. But I think what would benefit the group to understand is during that comment period that was twice extended, as Adam mentioned, KBRA had close to 100 conversations with market participants, which included insurance companies and regulators. And in all of those conversations, those regulators and insurance companies expressed a deep concern about the proposal. And while we understand that the problematic sections of the proposal have been withdrawn, we do certainly agree with Madam Chair's notion that this needs to continue to be followed closely. And I think what's important to note is that S&P actually does notch in other asset classes. So I do think that this proposal with respect to notching in connection with their capital adequacy model, I think it is something that needs to be closely followed and is an issue that we all need to continue to keep an eye on from an anti-competitive standpoint. And I think if anybody is interested and hasn't seen it, I just wanted to note that the link to the hearing on the House Financial Services Committee is publicly available on its website. And we'd be happy to answer any additional questions if anybody would want to reach out to me directly or ask me here.
Thank you very much. We appreciate your time this morning or moving into this afternoon, depending upon where you are. With that, I believe we had another person that would like to be recognized. I have Director Huff. Would like to make some brief comments.
Thank you very much, Madam Chair. It's John Huff. I'm currently the CEO of the Association of Bermuda Insurers and Reinsurers, ABIR, as we're known. I was formerly the Missouri Commissioner, the Missouri Director for 8 years, and I was President of the NAIC in 2016, and have a history of working with NCOIL, and I appreciate the opportunity to speak with you today. I just wanted to highlight for the participants today that there are many issues in the S&P consultation beyond notching, and the notching issue has progressed because of the semi-withdrawal, I guess, by S&P, I guess, on May 8th, on the eve of the hearing. But there's a very significant issue that deals with debt and how different regulatory regimes handle debt, whether it has to be at the holding company or at the operating company. And I won't go into all the details here, but I will put a link to our comments, 18 pages of technical comments on the chat here, so people can take a look themselves. But I do think there's at least uncertainty on many of our members of what's going to happen in the fourth quarter. Will S&P move forward with some of this, some of the proposals, and then have a new consultation for notching and some other issues? It's very unclear. I will tell you, if this debt issue is decided in fourth quarter, that could cause some chaos, for lack of a better word, as we go into January 1 renewals for reinsurance. Our members are known for providing a natural catastrophe cover in many of your states. It's very important that coverage be placed at the reinsurance level to make sure there's adequate coverage, keeping rates affordable and accessible in your state. So I think you're very right on the mark to monitor this issue. it's of significant concern on these debt instruments. And I'll just give you one brief example. If they flip the switch and decide to go with this new methodology in fourth quarter, some of our members may have to scramble to completely rewrite debt instruments that were placed at very favorable rates because of the inflation that's taken place now and the rise in rates. They would have to rewrite those instruments at much less favorable rates. And then the same capital would be there, but if they flip this switch, it would be very detrimental. And of course, consumers would ultimately have to pay for those increased interest rates for those instruments. So I'll put the comments there, but I just wanted to make an intervention that this is more than just the notching issue.
Well, thank you very much. Missouri is my home state, so it's nice to see you. You would send those comments to Will. That way they can be made available with the full meeting. I'm not sure when we put them in chat if they disappear. So just make sure they're part of the permanent record of the meeting. So if you could go ahead and send those.
Will do. Thank you.
With that, I believe we've heard from all of our presenters. Do we have any questions from any committee members at this time? And Will and Tom, if you see folks, please let me know. I'm going across the views here. Not seeing anyone wishing to be recognized at the moment. So, go.
Not seeing anyone on our end, Madam Chair.
Okay, thank you very much. Just wanted to make sure we didn't miss anyone. So with that, that takes care of that business. This will be further discussed coming this summer's meeting in July. And of course, we will invite S&P again, and hopefully they will participate. The Committee of Jurisdiction on this is Financial Services and Multi-Lines Issues Committee. And we'll be having that conversation then. If there are any other questions or comments, please reach out to staff, and we'll be sure and take those into consideration. So I believe our next under the any other business section of the meeting, we have one last piece of business before we discuss adjournment. During the committee's meetings November in Scottsdale, the issue of legislative and regulatory obstacles to the recruitment and retention of insurance providers was discussed. On behalf of FinSECA, the Honorable Greg, I'm not sure how to say this, Serio, former superintendent of the New York Department of Financial Services, stated that the agent licensing process is something that needs a bit of a deep analysis and re-engineering in light of COVID and other developments in the past several years. The remarks were met with some pushbacks from a couple different groups, such as the Big I and NAFA. However, it's odd that after the pushback, proposals similar to what the superintendent mentioned were sent to NAIC's producer licensing task force in a letter signed by NAFA and others such as ACLI. So to the extent that any of these proposed changes to the agent licensing process require statutory changes, I believe it's incumbent upon NCOIL as the legislative organization that we should be the forum in which some of these issues should be discussed rather than NAIC. I believe those conversations need to be ongoing. This committee will be further discussing these issues during the July meeting. And I would encourage anyone with any comments to reach out to myself and NCOIL staff. Then would note that some of the points in the letter to NAIC just seem to conflict with points that were made to this committee in November. And I will ask the organization involved to clarify that inconsistency when we meet next month in July. If there are any interested persons who would like to speak briefly on this issue, we'd be happy to go ahead and recognize you. And then after that's finished, we'll move on to our last pieces of other business. So is there anyone that would like to add anything to those comments or possibly clarify any of the information that we just discussed?
Chairwoman Carlton, it's Melissa Bova from Pensacola. I just wanted to provide an update on our efforts based on the November meeting, if that would be allowed.
Please do. Thank you.
All right. Well, wanted to provide a brief update on Pensacola's efforts to improve recruitment and retention and diversity in the financial profession. As you highlighted, NCOIL was the first to show interest in this issue and allowed Greg Serio to present on behalf of Pensacola to you in November about our concerns. And we thank you for showing that initial interest and continued interest in the discussion. Retention in the profession does sit at 14% in just the first 5 years of employment. And during COVID, we saw an increase in individuals rightfully thinking about and focusing on financial security. So it's imperative that we increase and retain the number of people in this profession to ensure yours and Pensacola's shared desire for financial security for everyone. To that end, we certainly hope this committee will add to its July agenda a resolution that reflects your longstanding support of these efforts. And while some of these items we think could be done in a regulatory way, the bigger issues, the bigger recruitment and retention issues, we do believe need to take a legislative approach, and we hope to work with your committee to develop that legislation and move forward in those efforts.
Thank you very much. We've always found when it comes to this level of professional development that mentorship through those that actually do the job is one of the best ways to proceed, even though the regulatory body does have some issues, some appropriate oversight of this, because you always have to make sure that everyone's playing by the same playbook. When it comes to actually diversification and bringing folks in, I think that mentorship probably is very, very valuable. And that's where NCOIL can play a key component. So are there any other comments on this issue?
Madam Chair, this is Wes Spitz with a big eye. Can I jump in?
Sure, please do. Go ahead.
I welcome the chance to comment. I guess, you know, when we heard Mr. Serio speak to your committee in November, it was a little unclear specifically what he was proposing at that time. He talked a lot about a New York specific issue. I don't know if his organization has been looking to resolve that matter. I also don't know if they've submitted any formal legislative proposal. I mean, you know, as we said that day, I'll say it again, if there are specific ideas on the table, we'd be happy to look at those and to comment. And we would be concerned, though, with any kind of effort to water down the standards that might apply to agents, and especially those that would have the effect of adversely affecting consumer protection. So I would hope all the groups, whether they're commenting to you or reaching out to the NEAC, we'd urge them to be very specific about what they're talking about. And kind of get beyond sort of nebulous concepts and be very precise. And I think that'll foster maybe a more meaningful conversation about what can actually be done. But I agree with you wholeheartedly that this is an issue that if anybody's going to take action on it, you know, it ought to be NCOIL very much engaged. So thank you for that opportunity.
Thank you very much. We appreciate that. Our job as legislators is to protect the public. So that's what it all boils down to.
100%.
Represent our constituents. So with that, any other comments? If not, this will be discussed in July. So I look forward to having the conversation. And if anything comes up between now and July, staff and I are available to speak on this issue. One last thing, registration for the summer meeting in Jersey, I believe is still open. And if you haven't registered, please do so. If you need any assistance, please reach out to the NCOIL staff. Is there any other comments for the good of the order at this time before I take a motion to adjourn?
Thank you, Madam Chair.
Thank you, Mr. Cooley. So with that, I would be happy to accept a motion to adjourn.
So moved.
Madam Chair, Carl Anderson, I so move that we adjourn.
I second it.
Motion from Mr. Anderson, second from
Senator Hackett.
Mr. Hackett. Nice to see you.
I see you.
All those in favor, please signify by saying aye.
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 Thank you all very much. Everyone have a safe and healthy weekend and look forward to seeing you all in July in New Jersey, if I can figure out how to get there from Las Vegas. Thank you all very much. So have a great weekend. Thank you.
Very good. See you. Thank you
Bye,
all.
everybody. Thanks.